the rate projections, I see 15 and 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if
Guys, why did nobody tell me I'm not on YouTube? Fam, this whole time I haven't been streaming. We got 30 people in here. Nobody wanted to let me know that we're not on YouTube.
make a September interest rate cut possible.
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the dot plot, their dot plot and everything. And what I hear and see is that people are looking at
Yo, that's tragic. Guys, if you just if the stream just started, YouTube lied. I hit the start stream button about half an hour ago, had to get started, but have not been streaming. Shame. So let's get to the rest of the press conference. I'll give you guys my updates at the very end.
look at all. I look at all of no one brings to this or takes away from it that is on the committee a really strong commitment to a particular rate path. It's actually just their forecast and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly more good inflation readings will help with that. I'm not going to be specific about how many because, really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that. And we see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. And I'm not going to get into the specifics, but you have the ability to do that so that.
So I guess they really are data dependent. If they didn't decide the interest rate until this morning, because the inflation print they're talking about was 5 hours ago. That just happened. That means they just made the decisions this morning.
The initial CPI reading and it's, kind of first.
But it also gives me a little bit of confidence, Like if they're winging it, maybe I'm not doing too bad,
Whether they should make changes. And as I said, some people generally do, but most people generally don't.
John Allen.
Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen?
Yo, VIP members, go on your own chart. draw a fib from this wick to this high right here, and if it comes down to 88.6 right here of that wick, and then closes back above, this thing's gonna fly up. So there's a buy opportunity here off of just a retest, almost a double bottom 886. Personally, I'm gonna wait for this deeper retracement 886 of the break right here. If I don't get that retest, I'm not in. But just letting you guys know, I know some of you guys are fiends. You're already loaded up, so there's the entry right there.
So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low, but it's moved up a little bit.
Chris, you're a genius. Chris said, I think they polished up the CPI report for the Fed meeting, not the other way around. Oof.
Even though they
Take the tinfoil hat off for a sec. Let's finish the press conference.
they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully. And that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand. And that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is.
He actually answered the question. Mike, go ahead and chalk it up. Whoever I made that bet with last year about Jerome never answering a question, you win. All right, come and find me after.
Neil Irwin with Axios. Back on the rate path, the SEP showed quite large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. How can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year. And as I mentioned earlier in the, what did we take away from this? We had really, really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year, take place next year. There are fewer rate cuts in the median this year, but there's one more next year. So if you look at year end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way.
This is NAS 100 for everyone who's asking.
He has repeatedly surprised.
Meaning the one guy that asked. And Mike, you can still get $15 haircuts. I know inflation is bad. You can still get $15 haircuts in prison. All right. Yeah. 5% inflation, my ass, people.
Look at the balance of risks.
Gina.
Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. How should we interpret what that means about how the committee views its current policy setting?
So 2 things about that. One is this. You're right, it did move up, but I want to remember to point out that long run neutral rate of interest is a long run concept. It really is a theoretical concept, can't be directly observed. And what it is the interest rate that would hold the economy at equilibrium, maximum employment and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today, we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were, very low by recent history measures. Now, we can't really know that. That's an interesting dispute and discussion to have now, but ultimately, we think that things like the neutral rate are driven by longer run, slow moving forces. And, there's a really good question about whether those.
I'm sorry, I can't even let him finish. What the fuck did he just say? We're going to go back and review this after. He said the longer term target is kind of almost maybe based on something we made up, and it's on forces that are long term. And it's a really good question that we should bring up sometime. That's not a fucking question. You should have the answer to that. That's your whole job is the interest rate. You're telling me that the neutral rate, which is that 2% target, and what they believe to be that efficient rate could go down, could go up. Somebody ought to look into that. Thanks, Jerome.
I think for the reasons I talked about.
So he said basically someone ought to look into that. We're fucked.
Restrictive and is having, the effects that we would hope for.
Well, next year, pal, Howard Stein with Reuters. Just to carry that a little further.
Howard,
should we
Schneider.
read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as cut?
Oh, for the fiends. Entry coming in soon. To be honest, do a tester on that first entry on the Model 2. Save some ammo for Model 3. I'm only going to take Model 3 for this one.
This is about, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me, the focus is more on we have. There was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think what curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long run potential throughout the forecast period, unemployment that never goes above the long run estimate, right? Of 4.
You guys make sure to stick around to the end. I'm going to give you a full breakdown, kind of 30-second breakdown of what just happened. I'll do it in plain English so everyone can understand. We should have another probably 10, 15 minutes of the press conference, and then we're ready to go. All right, so stick around, and I'll have a promo code for you guys, custom, for the masterclass.
The unwinding of the pandemic-related distortions to both supply and demand. And that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down really fast. Actually, see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that though. We're look at today's report. If we see more like that,
I'm down to demand.
We can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Yo, incredible. Right? He should be a politician. He's not a politician, by the way, whoever said that. He's a bureaucrat. Politicians at least get elected. We actually choose these people. We're the idiots. This guy was appointed. That's why Trump, we'll get to that later.
See any slowdown in
Michael
the rest of the
McKee,
year,
give us
nor
something
does the
good.
unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point?
Cooked. He basically just caught him in a lie. He said, if nothing changes, then why would your forecast change?
If you just
Great
set policy
question.
at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that, you know, since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but, you know, no one has that as their base case. So no one on the committee.
No, he eliminated the possibility of hikes when he said we're at the end of the hiking cycle and this is the last one back in November.
Good progress on inflation with growth at a good level and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that. But so far, they haven't had to. And, you know, that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market while we're continuing to make progress on inflation. So I mean, we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability banks in leaving rates where they are for too long at this point?
On housing, you know, the housing situation is a complicated one, and you
Yeah,
can
it
see
is.
that's a place where rates
No
are
one
really
can afford a
having
house.
significant effect. I mean, ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, you know, low mortgages. In terms of banks, the banking system has been, you know, solid, strong, well-capitalized lending. You know, we've seen good performance by the banks. We had the turmoil early last year, but, you know, banks have been focusing on bringing up their liquidity, bringing up their capital, and having a risk management plans in place. So the banking system, you know, seems to be in good shape.
Chris.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance and inflation expectations appear to be well anchored. You're seeing, you know, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, you know, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more
So
about it.
I think it's true that that inflationary pressures have come down, but we're still getting high inflation readings. So, you know, and I think you can see it in various places. You know, in some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand. And, you know, we've taken some signal from that, but, you know.
You put sanctions on foreign countries, it gets more expensive to buy their stuff. Said, oh, it's really hard to understand the increase in supply chain prices, and which is causing pressures on inflation. Oh,
These are still running, you know, I would say above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, you know, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
In the aggregate, what a sellout! Y'all heard that in the aggregate at the end. That's like me when I say, yeah, it's a 12%. And then when I add on a risk adjusted basis at the very end, a fucking sellout, man.
One cut by the
It also means that they don't have a clear idea of what number they're really aiming for. As soon as they say in aggregate or on a risk adjusted basis or data dependent based on these multi-variables, it means we don't fucking know. And I'm gonna let you know when I know. Which is cool, but like at least say that.
How we look at it, really the whole rate path matters. And I do
They're just
continue
rolling
to
the
think
dice
that
as they
when,
go.
when we do
So they're just rolling the dice as they go. Me and them both, brother. All right, let's see how this trade goes.
financial market conditions and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time, but it's a consequential decision for the economy. And, you want to get it right. And fortunately, we have a strong economy and we have the ability to, approach this question carefully. And we will approach it carefully while we're very much keeping an eye on, downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We
Good question.
always want to avoid the tendency
Solid
to
question.
dismiss the parts of inflation that we don't like and just make it go away. So, but we had a quarter where inflation was running higher, and yet
Chris, he said, I wish we could just wave a wand and make the parts of inflation that we don't like disappear. Isn't that what they did by changing the metrics for the CPI report before the last FOMC meeting? They're like, we're not counting these three products anymore.
but we got a
Clutch.
third month, and we said, okay, the signal we're taking
Like, I wish you
is
can just fix the
that,
numbers.
we
It's like,
think it's going to take longer to
that's
get
what you were doing.
confidence that inflation is moving sustainably down 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction. But one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Jolene.
Hi,
Sora BH says, how's the scamming going? Ask your mother. You understand? Eye-to-eye contact. And come back with an answer for us. Pronto.
Good about this economy?
I don't think anyone knows has a definitive answer why people are not as happy about the economy as they might be, and we don't tell people how they should think or feel about the economy. That's not our job. Where people experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to.
Guys, stop laughing in the chat. It wasn't that funny. It was hilarious. And also, don't come at me. It's a dangerous thing to do. I apologize to anyone who found that in bad taste. I know we're watching a very exciting press conference, and I'm sorry to have bored you with my entertainment.
Who lower income people at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year. And I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing.
That makes one of us.
Expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect?
There she is. All right. I'm about to go to Jared.
For you, but what we said is that we want to make sure that we're
every kiss
actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time We very much want to get back to a place where people cannot think about inflation. It's just not a concern in the everyday economic decision.
Walter, I'm talking multiple carrots, my boy. I'm talking multiple carrots. I'm talking about they're gonna have to weigh this thing precise.
And we're in the phase now of just, sticking with it until we get it done.
Claire.
Claire Jones, Financial Times.
She said, "When are you gonna cut rates?" Oh my God! Just take it all. No prenup.
Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular?
Ouch.
Thank you.
No,
So
that's a hard
encouraging
question.
has been that growth, the growth clearly that we had last year, particularly the second half of last year, and we continue to see still strong growth or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that. And that's not what happened. Instead, the U.S. is anyway, and it's in sharp distinction with many other advanced.
Now he's talking his shit. He's basically saying, "Yeah, what's all that recession shit y'all was saying last year?" And he's got a point. So he can talk his shit.
So encouraging. You ask about what you.
We're gonna wrap up here. I think there's another about 4 or 5 minutes, and then we're gonna be good to go. Got a 2 or 3 quick points for you guys, and then we'll wrap up. Make sure to hit the like button in the meantime. I'm gonna give you guys a quick synopsis as soon as we're done with the Q&A here.
And we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning of when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increase.
I don't give a fuck. Owner's equivalent rent is a useless metric where they ask about 100,000 households, "Hey, if you were to rent your house, what would you charge?" How the fuck are you supposed to get an accurate rent measure by asking people their opinion on what they would? Owner's equivalent rent is a horrible metric. And he's like, "Oh, well, there's a lag in it, and we don't understand why it's not accurate." But just talk to the management companies of every private company and just check the percentage increases in rents. But the problem is it's going to be way too high, and it'll make the inflation rate almost double digits. And that's why they don't report the true the true rent increase. They do owner's equivalent rent, which is some bullshit metric where they pick 100,000 random households that they pick strategically to make sure that number ends up lower than it should be. Make sense? Put a 1 in the chat if that makes sense. Put a 2 if you're lost. Put a 3 if you're thinking about lunch after this.
You should just ignore that, but that's not how we do inflation here. We do it the way we do it, and we're very transparent about it. And it's
I love you guys, man.
We're seeing.
And we're all in the same boat. You guys think I'm having a field day here? Well, you'd be right. I'm actually having the time of my life. And also, there's no gun to your head making you be here. So if you really want to leave, get the fuck out. Those of you guys that are sticking this through, you're champions. I'm gonna make sure that I give you guys that update as soon as we're wrapped up here. We got 2 or 3 more minutes.
Jobs.
It says pouring outside. Walter, stay safe out there, man.
January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what that you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. We remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home, but
all that extra money, all the excess from the COVID era is gone. I don't know why he's still making this point. No one is still saving money from COVID time. All right. I don't know about you guys, but that extra $500 that came in, I don't know if you guys are still saving that 4 years later.
Sector
It's gone.
in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as they're spending, or companies can't hire
So
like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction.
That's because we've been importing all of our stuff and we've barely been exporting. So spend a lot and don't make a lot. Sounds like the average American consumer too.
A good pace of growth for the U.S. economy. But you're right though. We do see the same thing other people see, which is increasing financial pressures on more lower income people.
All right. Yeah, I don't think we're going to get this retest on NASDAQ, guys. I think it's just going to continue to rise from here. Anyone of you degens who took the trade, let me know in the chats here.
I've done ultimately to get inflation under control because
It's US 30, Roy. It was perfect.
Right.
I saw it earlier, dude. I saw it loading up after it made that fat liquidity grab, and then I saw it reject yesterday's lows. Good catch. Really, really good catch. I'm wondering why NAS is lagging so much though. Normally, like with the news that came out today, NAS should have been front running US 30, but that's the game we play.
Cut sooner. And I was just wondering, can you talk a little bit about what that would look like? Is it more of like
Oh, Victoria is the one that asked that really good question last time.
jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
You see him get uncomfortable right there.
Yeah.
But he's sweating bullets right now.
The first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move and to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So and also the fact that we look at all of the whole situation. So, a decision to begin to, loosen policy could have several reasons associated with it at a given time. But I would just tell we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I mean, I can think of things that many things would make it on that list, but I don't think I'll butter them here.
Classic. Jerome Powell not giving us any actual answers at the press conference.
Simon Urbanovich,
Big surprise.
May I ask you?
Shocked even. All right. I don't know how many more questions these guys got. Jerome Powell is definitely getting pissed. I'm pretty sure he looked at his assistant and said 5 questions. And we got, okay, now we're at the Economist, for God's sakes. Who's next? Right? Who's next? We're going to get Babylon B in here too? Who wants to do a piece?
Than you currently.
All right. That was disrespectful to the Economist.
Kind of, I get that, as many good ones as we had bad ones, but no, it's not like that. It's going to be the totality.
I'm going to give you guys the synopsis here. I like Jerome Powell. He's really not answering questions. I was waiting for it because he answered one truthfully, but the rest of them, he's giving these canned answers. Let's go through the top 3 points. Number 1 main point, no rate cuts this time. Number 2 main point, we're actually getting closer to the rate cuts. He just said that they're expecting the federal funds rate to be at 5.1% at the end of this year. Right now, we're at 5.5%. Okay, so if we cut twice, meaning November, or we're probably going to be looking at October and November meetings, rate cuts in both of those meetings. So no rate cuts until Q4 is what Jerome Powell just said. Pretty big news. He said the labor market is strong, et cetera, et cetera. But he also said they're expecting 4% unemployment at the end of this year and then 4.2% unemployment at the end of next year. How is unemployment supposed to be worse at the end of next year? That don't make no sense. Trump's going to become president. He's going to create all these jobs. All right, slight joke, but also I'm being serious. I don't understand if they're forecasting a recession or some kind of labor market recession going into next year. We'll see. 4.2% is not even a problem. It's just more about the actual percentage change and the rate of growth. Zoom user, whoever that is, stop geeking at my funny ass jokes. All right. You know, he said Donald for the win. Yeah, we already know. Okay, so those are the main 2 points. 5.1% Fed funds rate by the end of this year, meaning we have 2 rate cuts to be expected. The markets don't really care about how many rate cuts we have, by the way. Those watching at home saying, well, more rate cuts or less rate cuts should have this reaction on the market. Markets care about expectations versus reality. If the whole market now knows that we're going to keep rates longer until October, and we have a very clear policy framework for the next 4 months, then markets can just have a relief bounce and then go bullish. You guys understand? Markets are bullish unless there's an emergency. If everything comes out as forecasted and there's a clear framework that people can invest on for the next 6 months, because Jerome Powell gave us the blueprint, then markets go bullish. Zoom user, my ass. Justin, I was about to say, who the fuck was that? Hey, at least you got a good sense of humor. It says Zoom user. Now I see in the thumbnail it says JC. Don't fucking, who the fuck? Just you about to fucking, are you giving me a hard time right now?
Bro, I don't know why it did. I don't know why it does that when I log in on my phone. I keep forgetting it says Zoom user.
Bro, I'm clocking 15 zingers today. I'm clocking 15 in a row, Justin. All right. I'm fucking hilarious. I'm doing God's work right now. You about to give me a hard time over the Zoom user when that was your name spelled in the chat. What are we doing here?
I got to give you material, bro. Come on. I'm helping you out.
You know Trump's going to win. And if the unemployment rate is higher than it is this time next year, I'll actually eat my shoe. How about that, people? All right. No one screen record that. That's basically what we got. I'm going to watch the rest of the press conference when I have a chance. I got to find a flight to Puerto Rico now because Miami is off limits. Be safe out there if anyone is there. If you guys are trading NASDAQ, I'm looking at 19,625 as the first target and 19,650 as the second. So that's what we got tomorrow morning. Fresh trades. Do not chase these trades, people. Don't burn your ammo. Save it for tomorrow morning. We'll come back and make some money together. Deal? Put us something in the chat if you guys made money, didn't make money, learned something, didn't learn something. If you're still breathing, if you're not breathing, put something in the chat. Said, have a good flight. Mike, I got to find one, brother. And I got to go see the man, the myth, the legend, Swaggy C. But obviously there's, I don't know, World War Z or something happening down in Florida. So we'll make the best of it. Walter, Gabe, everybody who's down in Florida, make sure you guys are safe out there. I'll see y'all soon. Yep. US 30 is lagging. NAS is way up. Today in comparison? No, other way around. US 30 is definitely leading today. Take it easy. Happy and safe trading, everybody. Leave a like and subscribe on the way out. Oh, I said there's 3 points that Jerome Powell made. How could I forget? First one, he made the inflation target. Second one, the interest rate target. And number 3, he said, click the link in the description for 25% off your seat to the NASDAQ Masterclass. You're welcome. Tell a friend. Get your money up, not your funny up. Happy and safe trading. Peace.